Well, UK stocks took an absolute battering yesterday. Some of them stocks were down an absolutely huge amount. The only positive is that actually some of these stocks that took an absolute battering yesterday, opening up down 10 plus percent. Some of the buyers started to come in some of them stocks, and a few of them stocks did start trending upwards, so they weren't down 10%, they were down 5%. Some of them got actually quite close to break even, but what that has done has added more on the UK side of it, which has been pretty much avoiding a lot of negativity at the moment. We know a lot of this negativity started in the growth and the small caps, and then a lot of people, quite a lot of investors that don't invest in them sort of spaces, well, we're just going, oh, well, it's just them stocks are overvalued, everything else is fine. And then what has happened is that has now creeped into the big US markets, it's creeping into the UK markets, and the UK stocks have took an absolute battering over the last few weeks and months. And today we're going to go through some of them and just talk about it, and overall I'll give my opinion on it all. Just going to say, very sorry there wasn't a video yesterday. The reason there wasn't a video yesterday is because on Saturday I made this video on Patreon, which was a review of earnings from the week before, which was about 45-50 minutes long, so that kind of took 5 hours to make. And then I made the video on YouTube, which if you haven't checked that video out as well, which was about 44 minutes long, which was responding to you guys that posted some comments on a video previously in the week. I said that, if there's anything you want me to talk about, drop a comment and I will reply to, if it's a popular one, I'll make a video on it. And there was that many comments that were that popular that I thought I'll just make a video replying to your comments in a video format, a bit like a Q&A. And I've got to say the response to that video was pretty good. Seems like if you guys would like another video in that sort of format again at some point, which is pretty cool, so we might do that. But yeah, just to kind of make that video and the other video, it was kind of like, that was about 10 hours there, so that basically gave me no time to do a video on Monday. So sorry about that, but we're here today on Tuesday making this video talking about how bad a lot of these UK stocks are crashing at the moment. So one stock in particular that's crashing a huge amount, the Hut Group, or THG. We've covered this one on the YouTube channel before. Absolutely getting slaughtered. I mean, it was down 15% yesterday. It dropped, it had a bit of a recovery, and then it sold off again right at the end. And look at this. 91% down. I mean, it IPO'd last year, and since the IPO, when it was a £8 stock, I think it might have been at some point even a little bit higher than that. An £8 stock, it's gone from an £8 stock down to 80p. Unbelievable move. To see a 91%, you don't get these sort of drops in very established, well-developed companies. This is a company that is putting in, 1 billion in revenue, 860 million in market cap. It's unbelievable how much this is sold off. Like, there's a lot of controversy around this stock. Don't get me wrong, since it came onto the stock market, and it's well covered. But I mean, you're looking at something like this, 91% down. You don't normally get these moves in these well-established companies. Sure, when there's a little bit of controversy, when investors are a little bit nervous, when management are doing a couple of things they don't like, they are going to get hit on the share price. But I mean, you're talking like 30%, maybe 40%. 91%. I generally don't think I've ever seen a company that is as established as a Hut Group. The only time I've ever seen a company lose this much value is when there's like fraud allegations and the company's at risk of getting shut down. It's unbelievable to see this drop. And people have asked me before about getting involved in a company like this, and I'm thinking I can't really, because it gets the media and the shorts are all over this company. It's very much like a Boohoo situation, and I don't know if I could have another stock in my portfolio like Boohoo, because I have enough to deal with Boohoo without adding the Hut Group in. But I do look at this company at 80p and think, this is unbelievable. This company is ramping up revenue growth a huge amount. The parts of the business with the beauty side of it, ingenuity is unbelievably good, and that is probably worth more than $1 billion alone. It is fantastic, and I am looking at this one thinking, I do really want to buy this one, but I just can't at the moment. I've just got so much already to deal with Boohoo that I don't know if I could have another Boohoo in my portfolio. But I mean, this is screaming out as unbelievable. I mean, if you look at the performance, if you take the profit side out of it, because obviously there's a lot of expenses there with a lot of acquisitions from the previous year, so you take that off a blip. This company's just focused on revenue growth, and it stays, near break even while it does that. And just look at the revenue growth over the previous years. And this company's just been absolutely wiped out. And if we go off analyst forecasts as well, you can see here, this is when the profit's going to start come back after a lot of these investments. And just look at how it continues to grow. It's just, it's looking an absolute steal here at the moment. And a Boohoo, we were talking about Boohoo a second ago. 65p. We're talking about a company here that is below CV prices. In fact, the last time it was this sort of price, it's nearly when it IPO'd in 2014. That's how low Boohoo is. He's basically gone, we're going to value at where you were at nearly 8 years ago. And same again, you look at the company, look at this growth here. The growth is unbelievable in Boohoo. And same again, if you go off analyst forecast, it's just going to continue. And for some reason, there's just that much negativity out there at the moment that Boohoo is getting valued at IPO prices. It's like it's literally done nothing in the last 8 years. It's crazy. And you could say there's a bit more controversy around them sort of stocks, but even like legal in general, one of the, when you say like, really solid dividend players on the UK scene, legal in general, you can put Airtel Africa in that category now, the likes of Barclays in that category, really stable dividend players, even these sort of stocks, 22% down in the last 2 months. And once again, this share price is starting to get back to nearly pre-CV times. Obviously not down as the peak drop days, but you're starting to get to the same down there. 6 times earnings. It's never going to trade at a crazy earnings, but still 6 times earnings. 7.3% dividend yield. This. Look at the history this company has of just hiking that dividend up, and the payout rate is down at 50%. You got a stock like this now that's starting to drop off. Greggs. They've just reported earnings. Actually, I've just been reading it before actually making this video, and the earnings were pretty solid. The outlook was a little bit weak, I would say. That's probably why it's dropping. But everything else, the earnings were pretty good. They're paying a special dividend, so you're picking up a dividend yield. And this stock in the last few days, this is 31% on this one has lost its value. Barrett Developments, 8 times earnings, 6% dividend yield. Some of these, this is, I think it was BMBM, who's always in the comments, and he made this point on the last video, which is, at these sort of points, when stocks are dropping this much on the UK side of it, you're starting to see a lot of companies that, the stock price drops so much that the dividend yields is just going, absolutely insane. You would say that, the average return on the S&P 500 is, 8% a year, 9% a year. You're getting a dividend yield of 6% here, guaranteed, and then you don't take, without any share price appreciation in it. And same again, Barrett Developments, look at what it's valued at now. It's basically been stagnant for 1.5 years, and look at this pre-CV times nearly. The only time it's higher than is on the peak CV days. But when you go to the 1st of May 2020, nearly 2 years ago, the share price is absolutely stagnant. And you look at the performance once again, it's nearly the same as where it was pre-CV, and in fact now it's even going to start moving back more in the right direction with revenue and profit growth. And what it will continue to do is hike that dividend up once again. S4 Capital's starting to get valued at where it was 7th of August 2020. Nearly once again 1.5 years of share price performance wiped out on the company. And once again, you look at the performance of the company here. If you go from like December 2019, 215 million, it's now going to do 480 million, and that's June 2021. If we actually go on the future growth, it's going to be 653 million. And the company's getting valued at the same prices. It's crazy. The likes of Hollywood Bowl. This company, once again, this has been stagnant for so long. You're coming on nearly a year of this being stagnant, and the drop off that this has been on, down nearly 25%. And Hollywood Bowl's another prime example. Just look at this. Let's just go on this growth here. So pre-CV, we were doing 131 million and 21 million in profit. What are we going to do in a couple of months' time? 150 million and 27 million profit. And once again, you look at what we were pre-CV times, and it's not even higher than where it was pre-CV, even though it's putting mass amounts more profit in and more revenue in. It's crazy. Catebox, this is 4.43% dividend yield. The stock is valued at where it was pre-CV once again. And sure, this has some concerns that, okay, it got the inventory wrong. Well, come on, it surely got the inventory wrong and it should have been better, but there's no as far as we can see, dodgy numbers here. The auditors were happy to sign off their accounts. And you punish it by putting it down to pre-CV prices. I mean, it's crazy. I mean, just look at the growth of Cakebox, for example. How much that, since 2019, look at the profit growth, look at the revenue growth. It's nowhere near the same company as it was. And look at what it's getting valued at. There's just so many of these out here at the moment. There's a lot of UK stocks that have crashed a huge amount at really, really cheap prices at the moment, in my opinion. And I guess this kind of comes down to really 2-3 points, I guess. When you look at these sort of stocks at the moment, first of all, you got to look at valuations. Do you look at a lot of these stocks here, and do you look at the stocks like the Hook Group, Boohoo, Greggs, Barrett, S4, Hollywood Bowl, K-Box? Are you looking at these companies here going, okay, you know what, these valuations, they're okay, they're not cheap, they're expensive. I mean, if you're looking at that point of view, then obviously this isn't a steal deal right now. But if you're looking at some of these stocks now and thinking, you know what, these stocks are valued at what they were 2 years ago, and look at the profit and revenue growth on these companies, look at the metrics, look at what the metrics they're cheaping at, the cheapest metrics they've ever been at. If you think that's the situation, a lot of these stocks are unbelievable deals right now. We're talking about better deals than pre-CV. A lot of these companies now are metrics cheaper nearly than CV times, which is insane to think. You think about the benefits and the money that was made from buying in the CV dip. You're basically getting the same dip right now when you look at some of the valuations. So if you think valuations are still expensive or not, or fair value, then obviously you're probably not screaming to buy. But if you're looking at a lot of these companies now and the pre-CV prices cheaper than them, metrics are the cheapest they've been, there's so many deals out there. So that's the first thing you got to look at is the valuation side of it. Next point, which can be split into 2 points, is obviously you've got what is causing this situation. Well, you've got 2 kind of points here. You've got oil prices, which is slightly caused by Russia, and you've got inflation, which has been natural at the moment, I would say, but obviously now has been helped on by probably the Russia situation and Russia invading into Ukraine. So when you look at the Russia and Ukraine situation, you've got to look at that situation and think, first of all, the big issue that you have is, okay, what are Russia going to do after invading Ukraine? Are they going to invade other countries? If that happens, then that's probably going to cause a lot of pain for the stock market, and in fact it's going to cause more pain than just inside the stock market. I mean, you probably talk about the likes of World War III here, which you're probably going to be more worried about other things than your actual stocks at that point. But if that doesn't happen, which I don't think it will happen, then you look at the situation with inflation and oil. Well, that you would probably say that situation would calm down. And when you do talk about inflation and oil, is sure this is going to be extended prices in the short term. This could affect stocks. A lot of the cost is going to be passed on to a lot of the stocks. Maybe that's also passed on to the consumer. Maybe they do spend a little bit less. But I can tell you something, if oil prices go up slightly, if inflation carries on going up, there's a lot of ways to combat this. And I think this is all short-term issues, and I think this will be resolved. And at the end of the day, what a lot of these companies can do is they will actually, just increase the prices slightly, and that will cover the cost. But I think over the longer term, this will balance out. And you've got to look at the situation, like a Greggs, for example, going, you know what, it might be a bit of a bumpy month, a couple of months, and profits might be down, just get hit a little bit, revenue might get hit down a little bit. But at the end of the day, I going to Greggs in the morning, you've seen no slowdown in people going for, the bacon sandwich, the sausage sarnies, the cups of coffee, the cups of tea in the morning. People are still going there. People are still going there every morning. And you know what? There might be a slowdown, a little bit of a slowdown in the coming few months, and that might hit the company slightly. But is that going to affect them over the next 1 year, 2 year, 5 year? I don't think so. And when you factor in at the moment that how much of that is priced in, you look at Greggs, for example, it's on a 30% dip right now. There's already a lot of pain priced in to a lot of these stocks. And maybe this doesn't go for Greggs. Maybe Greggs wasn't a great example for this, but, let's go on to Boohoo, for example. Is like, you look at how much of that pain is priced into Boohoo right now. It's unbelievable how much it's priced into. But when you look at the long term and when this kind of recovers, when everything kind of calms down, do you think these companies will still do well? Do you think they'll still carry on putting in good revenue growth and profit growth? Do you look at Boohoo and go, yeah, they're probably still going to grow 20-30%, the profit's going to recover, and then you're valuing this company at the lowest it's ever been in 8 years. We talk about this negativity. How much is that priced in right now? Because to me, I'm seeing a lot of this negativity priced in. I'm seeing a lot of companies that are getting affected on a problem that will be around for the next 3 or 4 months. But is it going to affect these companies in the next 3, 4, 5 years? I don't think so. And then you take into the combination of these valuations, a lot of these companies are getting value. Look at Boohoo. A pandemic that we didn't know how bad this was going to be. How long is it going to go for? How serious this is going to be? It might, a very, very serious, issue here that is going to affect the economy in the world for such a long period of time. And don't get me wrong, Ukraine being invaded by Russia, horrible situation, horrible situation. But how much of that is going to, come into Boohoo? How much is this affecting Boohoo? Well, the part that's affecting Boohoo here is that oil prices are going up, and that hurts logistics. But does a logistic issue that could be resolved quite easily, is that does this justify this drop? Does this justify it to be the lowest it's been in 8 years? I don't think so. This is, for me, is a problem that can be resolved in a couple of months. And at the moment, it's getting, the negativity out there is worse than when we were at CV times, which is just bonkers. So yeah, I mean, for me at the moment, I'm seeing unbelievable bargains. Prices that I can't believe we're seeing prices lower than the CV situation. So for me, there's a lot of opportunities out there. I'm buying stocks. I bought 3 this morning, in fact. So yeah, I am capitalising on this market now because, in my opinion, with how much a lot of this has been priced into these stocks, I think we are set up for a mega rally when the rotation happens. So hope you enjoyed it. If you could, hit the like button if you're new, subscribe, and I'll see you next video.